It was two guests for the price of one this week, as we were delighted to be joined by both Laura Foll and James Henderson, portfolio managers on the global equity income team at Janus Henderson Investors. As the first post-election Labour budget at the end of this month gets ever closer, many segments of the UK equity market continue to trade on notable valuation discounts, both to global peers and their own long-run averages. Corporate activity in the shape of merger and acquisitions and private equity interest in UK corporates remains heightened. With all these factors combined, this was an opportune time to catch up with this experienced management pairing who are responsible for the investment portfolios of three UK equity-biased London-listed investment companies. Welcome to the Investor Insights podcast, hosted by Killick & Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killick & Co YouTube channel, or by searching for Killick & Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killick.com. Killick & Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website killick.com. Laura Foll and James Henderson joined Henderson in 2009 and 1983 respectively. They are the co-portfolio managers on three London-listed investment companies, the Henderson Opportunities Trust, ticker HOT, Lowland Investment Company, LWI, and the investment portfolio within Law Debenture, LWDB, alongside an open-ended income and growth fund. Each of these three investment companies have variations in approach and a differing investable universe, HOT being perhaps the most nimble and tending to have a smaller cap focus, Lowland sitting in the AIC equity income sector and offering a higher yield, and Law Debenture perhaps the most unique of all, with this independently run investment trust combining an independent professional services or IPS business sitting alongside an investment portfolio run by Laura and James. The IPS business provides a range of services to companies, agencies and individuals in the financial and professional services sectors, things like pension trustee and corporate trust services, amongst many others. This business accounts for roughly 20% of the net asset value or NAV of the investment trust, but punches above its weight in terms of income contribution, accounting for around a third of income generation over the past decade. This enables the portfolio managers to take a slightly more balanced investment approach relative to other equity income peers, while still delivering an attractive and growing income for investors. All three of these portfolios share a similar philosophy, and Laura describes this approach to both income, value and growth a little later in the discussion. Please feel free to get in touch using the podcast email address if you'd like any further details on anything discussed in this episode. James and Laura, thank you so much for both joining us today. How are you doing?
Yeah, good thing.
Well, it's very good to be with you. We look forward to chatting.
Yes, it's good stuff. So we've got this kind of standard opening question to these, which we ask kind of all of our guests. It aims to kind of set the tone, but also get a bit of an insight into you and kind of how you typically work. So I wondered if there's maybe an anecdote or research project you could kind of talk us through, or maybe a kind of interesting article or book or recent meeting that any kind of anecdotes you can give us, anything you can share?
I was going to do the first question and then Laura the second. For me, I was thinking last week that I'd been running Lowland since 1990, and every day is different. You think you're beginning to see patterns, and they're not always there. So last week was typical in that way for me. I saw two companies on the same day, and one is going really well. Ceres Power is really gaining traction. plant is being built, orders are coming through, and the other, also not so different in certain respects, 2 or 3 years ago, is a company that makes disc brakes, and these disc brakes will be needed in EV cars of the future, but it hasn't been able to get commissioned plant properly. And I went through all the problems, and I was thinking, I've heard this so many times, but I still wouldn't have known that they were going to get that wrong. So the fascination to me of the job is it's always changing, and you could see the same problem, but it will come out in a different way, and you'll see people actually make success, and the excitement of watching a company that was, when I first saw Ceres, it was just science, and they've taken that science and and now see plant be put up around the world, from Thailand to India to Germany, and it's still early days, but it's getting that traction, and that's truly exciting.
Yeah, good stuff. Yeah, no, really, really interesting insight into one of your days. Yeah, thank you for that. My next question kind of attempts to kind of frame the discussion. Really, I wouldn't mind you kind of just kind of talking us through your approach, because it is kind of that distinctive style to it. You kind of talk about kind of looking at markets in a contrarian way. I wondered if I could ask you just to, because it will help with the rest of the conversation, really, just to kind of summarize your approach and your style, and maybe are there kind of certain characteristics which you view as kind of typifying a holding or prospective holding for the portfolio?
Sure. I mean, bear in mind that there are 3 trusts that we run, and they all have their own slightly distinct style. So one of the common themes that run across all the 3 different trusts, I think you very rightly said, we are more contrarian and value focused, and that runs across the 3. And we don't just mean, well, it's on less than 10 times PE. You know, we're looking at valuation versus its own history versus its peers. But quite often with us, it'll be that there's some asset within the group that we think is being missed. So what I mean by that, something like IDS, which is Royal Mail, they renamed it, was held across all of the 3 trusts. And in that case, we thought that there's a European business here that's actually a good quality business, much better quality than the UK business, and it was being missed within the group. The market, because we're all based in the UK, was very focused on the UK, not valuing this European asset. So that was very much sort of fitting within our style. And then at the moment, we hold things like ITB or STB, which is the Scottish version of ITB. And in that case, both those companies have big studios, production businesses, as well as free-to-air TV. So everyone thinks, oh gosh, free-to-air TV, you know, it's dead, it's declining. But they're potentially missing that there are these production businesses within there. So that's how we tend to think about valuation, and that definitely goes across the 3 trusts. And then I would say the other distinct style is that we are, maybe unusually for income fund managers, we are focused on growth and earnings growth. And what I find really difficult is trying to value companies that are in managed decline. So we try to avoid those. So for example, we have no tobacco anywhere across the 3 trusts. I find those companies very challenging to value given what's happening with volumes. And if anything, that volume decline seems to be accelerating. So we want companies that are capable of growing. And just to give you an example of that, when we bought M&S a couple of years ago, it was because we thought, actually, this business can return to growth. You know, people think that clothing business is in permanent decline. It need not be. There are some changes that can be made. You know, food can be made more competitively priced. It can grow. So those are the 2 things. So it's about valuation. Definitely, we do have that contrarian feel, but it's also about are these companies capable of growing over the long term?
Yeah, no, thank you for that. Yeah, that growth part really important. I think in kind of explaining that. So, I mean, you've obviously got the range of strategies, but we've read in your kind of recent commentary, certainly for Law Debenture and Lowlands, that you've kind of described this gradual positioning slightly more heavily towards perhaps more domestic UK, and certainly the kind of smaller size businesses within that investment universe. Could you kind of give us a sense of the opportunities you're seeing there, because the sentiment's particularly weak, and perhaps put those current valuations in the context of history? Kind of what are you seeing in that segment of the market?
Yes, I think the valuation on the overall portfolio is the lowest, or is around the lowest I've ever seen it, at sub 10 times. This is lower than when I started running it in 1990, when people told me valuations were low. We'd had the shakeout of the late 80s. So that's exciting, because actually a lot of these companies will be coming through with earnings growth. I think the reason valuations have got so low is partly the fundamentals that have been challenging in recent years, from Brexit to cost of living. But there's also been something technical, and that has been that the UK institutions, particularly the pension funds, have been big sellers of stock. We used to have 40% of our pension scheme in UK equities, and now it's down to 2%. And that selling has been the other side of the buying, on the whole, been American overseas buyers have been buying as the UK institutions sell. And obviously the big international buyers don't buy medium and small companies. They're comfortable buying the Astras of this world. They don't go and buy the small domestic company. So you've had this sort of perfect storm for these medium and small companies, where there is this challenging background. Brexit meant people held back on some capital spend programs. The economy has been relatively sluggish. And then on top of that, you've had this technical factor. And actually all those may be turning around at last for small companies. When you get down to 2% in your pension fund, you're unlikely to go to zero. There's a chance you might double your holdings and go to 4% in time. So I live in hope on that, but that might not happen. But you probably see the last of the real selling pressure, or towards the end of that real selling pressure. And also then on the economy, we've had one interest rate cut, and there's probably more to come in the not too distant future. And the economy takes a while to respond to interest rate cuts, but interest rate cuts will stimulate growth, and in time that will really lead to better operating margin for some of these companies, because they've really focused on that cost. They've had a very difficult time, some of these UK companies, in the last 5-6 years. So they're very focused, cost-conscious businesses, and a little bit more on the sales, and suddenly the operating margin will surprise the analysts, and you'll get in a nice cycle of upgrades. So it is UK domestic that is really the outstanding opportunity, I think. But you want diversification. So there will be disappointments in that. You want to have a diversified, and we believe a relatively long list of stocks. So there isn't huge stock-specific risk in any one small company, but we've got quite a few holdings in smaller companies that we do genuinely believe will be substantially bigger companies in time. So it's an exciting time. When you come out of recessions, usually on the first interest rate cut, the market doesn't go up, because there are these factors coming through. There are downgrades coming through. That's why you're having the interest rate cut. Once you've got through that, you have the second and third interest rate cut. That's often the fuel to the economy, to the market, and the market goes better. That's usually the shape of the cycle. So that's why we're net buyers at the moment, looking for opportunities. And as you rightly say, there's a bias towards medium and smaller companies. Many of them are with domestic earnings.
Yeah, no, there's some really interesting points in there. Yeah, I mean, you referred to quite a few kind of potential catalysts there that might kind of reinvigorate the UK market. I mean, what one of the other ones, I guess, is corporate activity, kind of external buyers coming in, and we certainly have seen the emergence of that in more recent times. Law, I've heard in some of your presentations though that you've kind of had mixed feelings towards some of these takeovers, particularly those where it's private equity involved. Could I ask you to kind of summarise kind of what you're seeing there in your thoughts?
Yeah, I think mixed feelings is a good way of summarising it. I mean, takeover activity has always been part of our strategy. You know, I can't think of many years where there haven't been a handful of takeovers for the types of funds that we run because of that valuation focus that we have. But there has definitely been a step up in the level of that takeover activity, particularly for a trust like Lowland, where the sort of remit that we have is mostly smaller companies and an income remit. So it focuses the mind on certain type of domestic, smaller but cash generative business. And if you're sat in private equity and you're sort of running the slide rule over the UK market, it tends to have landed you often in that Lowland type of company. And for Lowland over the last year or so, we've had a takeover every 1 or 2 months. It's been quite extraordinary, actually, the level of takeover activity that we've seen. And in some cases, when the bids have happened, so say for something like Debro, which was a sausage casing manufacturer, it got taken over by a European peer at what I thought was a perfectly fair valuation. I have no qualms with that whatsoever. Whereas a couple of months later, we had a company called Finsbury Food, which made cakes for the likes of Tesco and Sainsbury's. And that was taken over by private equity at what I thought was a really miserly valuation. So whether we're happy with it or not depends entirely on the types of valuations being offered. And as you say, it does often tend to be the private equity offers that are more miserly, whereas if it's a competitor, there are some synergies to be had, and you as a shareholder can share in that. And we're perfectly happy with that. As you say, it's mixed because it feels very nice on the day and you get a nice boost to your performance. But those companies, particularly something like Finsbury, I thought had a long pathway of growth ahead of it, and we no longer get to benefit from that. And the valuation it was taken over was very low. So it's good in that it helps your performance, and also it means that when you see us and other UK fund managers going out and saying the UK market is too cheap, it lends some weight to that to make you think, okay, well, maybe we're not just talking nonsense. There's someone else out there that wants to buy these companies as well. So it helps for that, but at the same time, the market is shrinking. That's unhelpful. So it's not a dynamic that I would want to continue for any long period of time. But in the interim, it can be quite helpful. I would hope that the UK market would re-rate to an extent where we don't see the level of takeover activity that we're seeing at the moment.
James, you mentioned pensions in an earlier question, but I also picked up, you wrote a really interesting article in the FT, I think it was last month, that touched on a number of points around pension plans and moving to surpluses and kind of allocations within pensions as well. I wondered if, could I ask you to maybe summarise the key points of that article for our listeners? I was particularly interested, one of the concluding points of that article was related to the potential for policy initiatives. Kind of, we've seen a number of these that have been tabled to try and encourage higher allocations to the UK. And given that we're kind of ever closer to that first Labour budget, it seems pretty timely. Could you kind of run us through your thoughts on all of that?
Yeah, that's very perceptive. I think it is timely, this Labour, this budget. You have to remember that it has been policy decisions in the past that has led to this move of people's savings in their pension away from equity. So the old schemes had this big weighting towards equity, and then when I think you have to a bit of a history lesson. When Bob Maxwell fell off his boat and died, they found that he'd been raiding the pension scheme of the Mirror Group, and it was a disgrace. And the regulator reacted to that by wanting to de-risk, put in real safeguards. At the same time, not long after the Labour government under Gordon Brown took away ACT, which was Advanced Corporation Tax. The Advanced Corporation Tax meant that for a pension fund, they reclaimed the tax paid. So it boosted the yield that they were getting on the portfolio. So whilst the pension regulator wanted to de-risk funds, also they'd lost the ability to gross up their income pension funds. So they moved down and moved away from equity. And so it was driven by the authorities in those two ways. And now it is where so many people have got their savings in their pension schemes, and the pension schemes aren't getting invested in UK companies. And UK companies have had a relatively poor productivity record in recent years. And one of the reasons is a lack of capital spend and a lack of, because your equity is too cheap, you have not been able to tap the market to fund expansions, to fund necessary capital spend that would improve that productivity. So I think there's a chance that policy can work the other way, and that policy could work towards returning pension funds to investing in the UK. It'll take time, but I think that could be the direction of travel for at the level of policy making to push that way. And who knows, we might see that in this coming budget. Anyway, leaving that aside, some of these pension schemes are now moved into surplus, and that should allow the trustee to be more ambitious. The trustee has been buying gilts to make sure there was no nominal risk in people's payments. But actually, there's no nominal risk in the payment of the pension. That's not been a protection against inflation in recent years. So if they may be able to be more aggressive in their policy now some of these funds are in surplus, and that would be good for the beneficiaries of the scheme because it might help them get some inflation protection. And other schemes in surplus may be able to do imaginative things. And there is a case in point would be Premier Foods, where the combination of a couple of its pension schemes meant that the company no longer had to feed money into its pensions and was able to spend on its products. And I wanted to, in the article, use the example that Bisto gravy is now being advertised. And I was told that everyone was too young to know what about the Bisto gravy adverts. But anyway, so the point being that companies again can spend if they don't have to put money into their pension scheme. And a pension scheme in surplus can take a more aggressive stance in its asset allocation. So that might be beginning to happen. What would really help would be if we saw a move by the government to encourage or make pension schemes move towards equity, particularly UK equity. And it is possible that might happen. It would be only on the margin to begin with, but it could grow, and it would be very good for the beneficiaries of pension schemes in time to be in equity rather than in gilts.
Yeah, absolutely. Yeah, and it'd be a big impact if things do start to turn a corner there. Yeah, for sure. Yeah, thank you for running us through that. Our kind of standard, we've got a standard opening question and a standing closing question to these. Our last question hopefully isn't the trickiest one, but it asks the guests to highlight one or a number of areas of their investment universe that they have particularly high conviction in at present. And I wondered if you would highlight some areas there.
Sure. I mean, it's funny that you say it's not a tricky question, because whenever people ask me what my highest conviction name is, I often am stumped. And I know that sounds strange, but we're running long lists in all of the trusts. We're not high conviction managers. That when we're buying new positions or adding, it's because we think on balance they're too cheap. But it is a long list. It's deliberately diversified. But with that context in mind, where do I see the best valuation? I think it is the smaller, more domestic businesses that are the most friendless. At the moment, they have had multiple overhangs in recent years, so most notably Brexit, but also liquidity and all of the technical points that James was talking about. And we need to remember that these are often very well managed, often conservatively managed, market-leading businesses that, if we go back to square one of how we value these companies, would look very attractively valued. And as we've discussed before, we are not the only buyers of these assets. There are, whether it's private equity, whether it's other peers, there are other potential buyers as well that value things as they should be valued, just on a simple measure of their cash flows rather than on all these technical points around the UK market at the moment. So I would say that is the area that to me looks the most attractive. But what I can't say is what will happen over the next 6 months or so. We've got the budget coming up. That's definitely adding an overhang. Whether fair or not, we will wait. We'll have to wait and see. But if I was to sit here and say, okay, in 3 years' time, do I think some of these areas that look particularly friendless are too cheap? Yeah, I think on balance, I would say that. And it often tends to be the companies that are below, say, 200 million market cap, where they really are being lost off the radar of most UK fund managers. But again, these are perfectly profitable, established businesses that should be valued off their cash flow and not off technicals and sort of sentiment towards the area.
Yeah, no, thank you for that. No, I completely agree. I think it is the trickiest question, because it's the power of the portfolio combined which has the biggest impact, but not the kind of individual. Certainly in the case of a portfolio like this. James Law, thank you so much for sparing some time today. I really appreciate you speaking to me. Thank you.
Well, thank you very much. Good, and I enjoyed that.
Thank you for listening to the Investor Insights podcast, hosted by Killick & Co. You can get in contact using our podcast email address, investorinsights@killick.com, for more information on any of the topics discussed, or for further details on the services offered by Killick & Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killick & Co is authorised and regulated by the Financial Conduct Authority, the FCA.